Traders, you are pretty much screwed because there are so many strategies out there. How do you know which one is right for you? Well, let me help you guys because we are going to look at some of the most viewed, some of the most trending strategies online to see if they actually work and if they are right for you. So let's get into it. Traders, I just had to check out this video. Look at the title. It says every trading strategy explained in 12 minutes, right? A pretty bold statement to say the least. Now, obviously, it's not every trading strategy ever, right? That would take you about 20 years to go through them all. But what it does do is look at some of the most popular trading strategies out there, okay? And what we're going to do is look at them in two ways. First of all, we're going to look at them as in, can we simplify them with price action, or would even price action be a better way to trade it? Or is it indicator heavy and therefore you would be better off using an EA or a robot anyway? And some of them might just be complete crap, and we will point that out as well. Now, this video has 2.5 million views and over 2,600 comments, which is why we're looking at it today as well, guys. We wanted to find some of the most viewed videos online. So let's get stuck in. Let's look at every trading strategy explained in 12 minutes.
Fibonacci retracements. It is a tool that displays horizontal lines based on the Fibonacci numbers. These lines can then be used as key support and resistance levels. To use the Fibonacci retracement tool, you first start by identifying a swing low and swing high on a chart. Then, drag the tool from the swing low to the swing high. Next, wait for the price to make a pullback to one of these levels, ideally the 0.382 Fibonacci level, because that's the most common level where price tends to reverse from. So if price touches that level, that could be a good buy entry. Keep in mind that price could also reverse from other Fibonacci levels.
Right, guys, so there's Fibonacci retracement levels, right? And these are widely used. But again, I would say you don't really need them if you understand price action. So let's take a look at what I mean. Now, first of all, I disagree with what he said. He said the 0.382 level was the most commonly used Fibonacci retracement level. And that's just not true, guys. The 0.382, the 0.5, and the 0.618. All of these are the key Fibonacci levels, and price could retrace to any one of these, okay? When price does, we're looking for a reason to enter the trade, right? And you can see here we get a nice big bullish candle. We don't know what time frame this is, but it could be any time frame, right? We get a nice bullish candle, and we could start buying this from here because we're in an uptrend and we look for a retracement to one of these levels. Okay, so that's Fibonacci's, right? And I like Fibonacci levels because they're one of the few indicators that are not lagging, right? They are static areas on a chart. But again, price action is a more robust and easier way to trade it. Okay, because if you look at these two levels here, right, we had this last high here, and then we had this bit of resistance level here. So if I just draw a level through here, right, that was once resistance, and we know that what was once resistance becomes good support, and price bounces, get my teeth in, price bounces exactly off that level. So again, price action can explain this trade far easier than fib levels. Although you can use fib levels to back up the area that you're looking at. If you like this as a potential support level in here, okay, and then you also use Fibonacci levels as well, it could be good double confluence for you to take the trade. All right, but yeah, fibs hugely popular and widely used and are a pretty good indicator, guys, but price action will tell you just the same. Right, next strategy.
Breakout patterns. It is when price makes a sudden and significant movement towards one direction. This usually forms after the market makes a consolidation period. For example, Here we can see that the price is consolidating. Then, it suddenly moves sharply to the downside. This is called a breakout. To take advantage of this, traders could use specific patterns as a guide to identify breakouts before they happen.
So guys, again, you do not need to know chart patterns, right? All you need to know is price action, because every chart pattern is explained using price action, okay? So let's take this triangle pattern right here, okay? So what's happening? You have price, okay, keep hitting a resistance level. Therefore, we don't know the trend. The trend hasn't been confirmed. But as soon as it breaks these highs in here, right, we know that we now have higher highs. And price action tells us that that is an uptrend and we can start looking for buys. Okay, so we can start buying in here, right? Stops below here, and we can take price higher. Now, that is the same for every chart pattern that we're going to see in the next couple of minutes, right? All of these are explained by simple price action. They are breaking a higher high or a higher low, or vice versa. Okay, so again, price action will explain every pattern, breakout or not.
Notable breakout patterns includes wedges, triangles, and the rectangle pattern. Reversal patterns. It is when price moves in the opposite direction of the current trend and forms a counter trend. Specific patterns could be identified in a chart, which could help traders predict reversals before they happen.
Again, guys, yeah, it doesn't matter if it's a breakout pattern or a reversal pattern, it is price action. Simple as that. Now, if you didn't know head and shoulders existed or triple bottoms existed, but you do know structure and trend, you are okay. Because let's look at head and shoulders, for example, right? We're in an uptrend, higher highs, right? Higher lows. We're in an uptrend. We're still in an uptrend because these lows never break, right? And then finally, bang. When we get a break of this level here, we have had a break of structure, and therefore we've gone from an uptrend to a downtrend. And we can start selling from this level here, stops above here, and take price lower. And it's the same again for triple bottoms, double bottoms, cup and handles. It's all about break of structures and understanding price action. Okay. And guys, if you want help with price action, please check out our website. We've got loads of tutorials on there.
Elliot Wave. It is a theory that suggests that market tends to move in a series of 5 waves before reversing and forming another set of waves in the opposite direction.
So again, guys, this is price action 101. Now, a lot of people ask me about Elliot Wave. And for me, I just say it's simple price action, right? It doesn't matter if it's wave 2, 3, 4, 5, wave A, wave B, wave C, because the market can do whatever it wants. But if you know the trend and structure you're in, you are fine. Now look at this, right? We are in an uptrend, okay? We are getting higher lows, higher highs, right? Fact. We're still getting higher highs here, okay? But we're now starting to get lower highs, right? But as soon as this level breaks, that's when I'm interested in selling this market, because this is now in a downtrend. And when we're in waves 2, 3, 4, and 5, I'm interested in buying. Now, it doesn't matter if I know Elliott Wave or not. It really doesn't. It's important that I know market structure and trend, and that is simple price action. And that is all that Elliott Wave is.
Fair value gaps. A fair value gap occurs when a candle forms a significant gap due to an imbalance of buying or selling.
Guys, I get asked so many times about fair value gaps as well. And it's a smart money concept, right? Now, there's so many times where fair value gaps overlap support and resistance, right? I'm a price action trader and I trade support and resistance. Whether you call it support and resistance, fair value gaps, supply and demand is irrelevant. It really is. It's all about where price could react on the chart. Okay. And like with simple price action, okay, we are seeing an uptrend. Okay, fact, right? We're getting higher lows, higher highs. Okay, and then this area here, what was once resistance, becomes a very good area for buying. And you can see how that overlaps the fair value gap exactly. So again, you don't need to know where fair value gaps are. You need to know where the market has reacted before. And you can see the market has reacted here before as an area of resistance. And then when we break that area and come back to retest it, that becomes a very good area to continue the uptrend and start buying. Okay, simple price action.
To find a fair value gap, you first need to find a candle with a large body. Then, draw a rectangle at the gap. Place it between the previous candle's wick and the next candle's wick. This level now acts as a potential magnet for continuing its movement.
So this proves my point exactly, guys, right? You've got this last high over here where price has reacted. Okay, if I drew a level, from that last high, you can see that's exactly where price reacts. That is a support level. Okay, so a lot of the time, these support and resistance levels or fair value gaps overlap each other. So again, don't spend too much time trying to understand fair value gaps, support and resistance, supply and demand. You just need to pinpoint areas on a chart where price has reacted before, here, and then use that in the future to make informed decisions at where price could react again. As simple as that, guys.
Candlestick patterns. It is a technique that traders use to analyze future price movements by looking at specific candlestick shapes. Notable candlestick patterns include engulfing patterns, which signal strong momentum towards the direction of the engulfing candle, hammer and shooting star patterns, which indicates rejection as shown by the long wick on one side, doji patterns, which signals neutrality in the market.
So, guys, it doesn't matter if you don't know all the chart candlestick patterns. Okay, doesn't matter if you know all the chart patterns; they can be explained with price action. Candlestick patterns are the same, right? Your job with any candlestick is to read who is in control. Now, whether it's a doji or engulfing or whatever it is, just look at the candlesticks, right? This tells you buyers are in control. This tells you buyers are in control. This one tells you sellers are in control. All right. So that's all you need to do with candlesticks. Ask yourself who is in control, buyers or sellers. If you're not sure, stay out. If it's, glaringly obvious, take the trade, right? Don't worry about all the different patterns. Just ask yourself that simple question, who is in control?
Higanashi. It is an indicator that fully replaces a traditional candlestick chart to a Higanashi chart. When applied, it tends to give less noise than a traditional candlestick. A green Higanashi candle signals that the price is on an uptrend, and a red Higanashi candle signals that the price is on a downtrend. The size of the candle's body also indicates how strong a trend is. The larger the candle, the stronger the trend. Keep in mind that the Higanashi only acts as an indicator. It does not display the real market price.
So there are some pros and cons to Higanashi candles, right? So the problem with them is a normal candlestick gives you so much information, right? You have an open price, a closed price, a high and a low. And that candle lets you interpret who is in control. And I explained how important that is, right? Whereas a Higanashi candle hides that information. It does smooth out price, right? Greens, uptrend, reds, bearish, downtrend, okay? But for me, they hide too much information, especially as a price action trader. Okay. Now, if you did want to trade Higanashi candles, you are better off putting them into a robot, right? Or an EA and letting them trade accordingly. Okay. But if you want to trade manually and read price action, then Higanashi candles don't help you do that.
Moon phases. It is a concept that utilizes moon cycles to time the market. Moon phase traders believe that moon cycles are correlated with human emotions and behavior, which could have an influence on the market. Specific moon phases are believed to be favorable towards a certain trend. A new moon means the market tends to be bullish, and a full moon means the market tends to be bearish.
Guys, if you are using the moon to trade, stop trading now. This is nonsense, guys, right? I mean, yeah, I don't know what to say. It's quite funny, in fact. But yeah, a full moon equals bearish tendency. So next time there's a full moon, guys, I want you all to start selling the market, whatever market you're looking at, because it's bearish. Yeah. Do you have the confidence to do that? Probably not. You're not going to rely on the moon. Okay. I would prefer to rely on price action.
Renko. It replaces a traditional candlestick chart to a Renko chart. So, unlike a traditional candlestick which forms a new candle based on a certain period of time, a Renko chart forms its block based on the change of price. For example, every 1% change in price, a Renko block appears. This means that each Renko block represents a 1% change in price. Of course, you can change the parameters of this through the indicator settings. Traders could utilize Renko charts to filter out noise and identify trends. A green Renko block signals an uptrend, and a red Renko block signals a downtrend. And keep in mind that Renko charts only acts as an indicator. It does not.
So, guys, very similar to Higanashi. They're really indicators. It's not real price, right? Again, candlesticks give you real price, real time information. These are like Higanashi candles. They're just smoothing out the candles. And again, if you're going to trade this, you're better off using a robot, right? When the Renko candles or squares go green, start buying. When they go red, start selling. You could easily program an EA robot to do that. All right. So again, not a big fan of this, unless you want very mechanical trading. And if you do, hire a robot.
Harmonic patterns. These are advanced price patterns that follows a specific shape based on Fibonacci numbers. Traders can then use these.
Again, guys, don't overcomplicate things. Harmonic patterns, I am aware of them. I've never traded them, but why would you use something so complicated? It's just going to make your life hard as a trader. And picking these points here, A's and C's and B's, what's the criteria for picking these? These are going to be, highly subjective. Okay, so unless you are skilled with using harmonic patterns, I would definitely not start there as a new trader. In fact, anything that's so subjective and difficult to pinpoint certain areas on a chart, stay away from, right? Again, all the information you need is in the charts in terms of price action. But let's hear them out.
Specific shapes to predict future price movements. For example, a bullish bat pattern is formed when price makes a series of 4 movements that is shaped like the letter M.
A bullish bat pattern. I rest my case. Should we go any further with harmonic patterns? No, we shouldn't.
Support and resistance. These are key levels that formed horizontally where the price has bounced off in the past and could possibly bounce again in the future. If the level is below the price, it's called support, where you can take a buy position if the price approaches it, and if the level is above the price, it's called resistance.
Now we're talking, guys, right? This is price action 101. And one of your number one jobs as a trader is to use historical information to make future decisions, right? And support and resistance helps you do that wonderfully, because you have these levels on a chart, whether it be resistance. Now, if you want to sell the market, resistance will be a good level to sell from, okay? And how you spot resistance is going back in time and spotting where if price has reacted at that level before. And the same for support, right? You've got some support here, right? If I drag this support left, okay, you can see it's reacted over here as well. See? So to qualify good support and resistance, you want many touches of price at those levels. And typically price will react at these levels in the future. So if you're looking for a sell trade in this instance, we get a nice bearish candle at a resistance level. That could be a great sell trade. Okay. When we're at a support level and you want to buy the market, we get a nice bullish candle at support. You can start buying the market as well. And in this example, you can see how they become good targets. Now, every time I trade, my target, if I'm buying, will be a level of resistance. And if I'm selling, will be an area of support. So not only are they levels where price can react, but they also provide very good targets for our trades as well. And you must be able to plot support and resistance accurately. Again, guys, if you want help with this, please come join our channel, subscribe to the channel, smash the notification button and smash that like button. Please come join our trading community where we talk about support and resistance plus much, much more. So please come join our free Discord. Check it all out. All the links are below.
Dynamic support and resistance. Similar to support and resistance, dynamic support and resistance also acts as key levels. But
again, now you're talking my language, right? So I do use one indicator, and that is the moving average 20. This looks like the moving average 50, right? I could be wrong, but it looks like the moving average 50. But what these moving averages do, they act as dynamic support and resistance, okay? So once price comes down to these moving averages, right, and we see a nice bullish reaction, if we're above the moving average, which we are in this case, right, we can start buying the market from these areas. What I really like and sort of brings in the last strategy they spoke about is when you have a moving average bounce plus a nice horizontal support level or resistance level, in this case, a support level. That is really nice confluence. So let me just reiterate that. You can see that that was once support, okay? And if I dragged it left, you can see it's been support previously, okay? You can see many taps at this level. And then once we get a horizontal support level with a dynamic support level, like we do in this occasion right here, that double confluence, that double support, what a great trade.
trend lines. Trend lines are key levels that form diagonally during a trending market. You can use trend lines to identify the overall direction of the price. Upwards trend line means bullish, downwards trend line means bearish. And
guys, I know traders that only trade trend lines. They don't even look at horizontal support and resistance levels. But my question would be, I would look at both, right? I would look at support and resistance levels. I would look at dynamic support and resistance levels in the form of a moving average. And I would also look at trend lines. If there's a clear trend line in the market where price keeps bouncing off, then of course I'm going to add that trend line. Trend lines, dynamic support and resistance, and support and resistance levels, horizontal levels, you must use them, guys. They give you so much information.
similar to support and resistance, you can also use the trend line to identify possible entry scenarios. For example, if price retraces back to a trend line, it can be a good opportunity to take a buy position. GAN Angles. It is a tool that displays multiple lines that spread continuously on different angles. These lines can then act as possible key levels and could also help you measure the strength of a trend. Price moving within the steep angles of the tool indicates a strong trend, and price moving within the shallow angles of the tool indicates a weak trend. To apply the GAN angles, first you go to Settings, then make sure to check the lock price to bar ratio. Next, identify a market range and mark the swing low and the swing highs of that range. Then, draw a straight vertical line at the start of the range. After that, select the trend angle tool and measure 45 degrees. Then, use the gun fan tool and place it at the 45-degree angle.
That is about as useful as an inflatable dartboard. So basically what he's saying there, guys, is showing you how to plot GAN angles. But, you know, he's saying you can get a reaction off this level, you can get a reaction off this level, you can get a reaction off this level, or you could get a reaction of this level. Now,
that is about as useful, as I say, as an inflatable dartboard or a chocolate teapot. Again, guys, looking at this chart, I'm just going to be looking for areas of support and resistance. You can see all these levels in here where price has touched. That would create a level of interest for me. Okay. So that's where I'll be interested in buying from. Okay. Not these other, lines on a chart that don't mean a great deal to anyone. I don't know any trader that uses GAN angles. It's the same with harmonic patterns. They are overly complicated. Why would you want to complicate your trading?
Momentum indicators. These are the types of indicator that measures the direction and strength of a trend. It is most effective when used in trading markets. Some of the most notable momentum indicators are MACD. An upwards crossover indicates a bullish trend, while a downwards crossover indicates a bearish trend. Moving averages. Price being above the moving average signals a bullish trend, and price being below signals a bearish trend. Parabolic SAR. A dot below the price indicates a bullish trend, and a dot above the price indicates a bearish trend.
Again, guys, right, if you're going to use any indicator, I'm not against indicators, okay? But in my trading journey, I have literally used every indicator, right? I've used parabolic SAR, I've used MACD, I've used Higanashi candles, I've used everything, right? But what you must develop first is an understanding of how to read the charts. And that is price action, right? Trend and structure, support and resistance levels, reading candlesticks, understanding that you're trading from value. If you can understand those key concepts, then that's all you need really, right? And then you can add indicators as extra confluence, okay? But if I just said to you, right, MACD, when we get a crossover, you're going to enter, you will probably not have the confidence in that strategy because you don't understand it. It doesn't make sense to you. So I would only use indicators as an extra piece of confluence on top of my understanding of price action, or just get a robot to do it. A robot can do a MACD moving average crossover better than you, right? So if your strategy is that mechanical, get a robot to do it.
Oscillators. These are the types of indicator that displays the relative strength of a price. It is most effective when used on choppy or sideways markets. Most notable oscillators include RSI. When the line is in the oversold region, it indicates a possible reversal to the upside. If it's in the overbought region, it indicates a possible reversal to the downside.
Again, RSI is a very popular indicator, right? And it does highlight overbought or overextended areas. But again, guys, I don't need an indicator to show me that. If I looked at this chart, right, and price is all the way down here, I know that's a little bit oversold. If price was all the way up here, I know that's a little bit overbought, right? And I'm not interested because there's no value.
Stochastic. If both lines are at oversold, it signals a possible reversal to the upside. And if both lines are at overbought, it signals a possible reversal to the downside.
Again, I'm not going to trade. I'm not just going to look at this indicator and it says to me overbought. And I'm going to be like, right, I'm going to start selling up here. Okay. I need price action to tell me this. Now, again, we don't know what time frame this chart is, but this is in an uptrend. Okay. We're getting higher lows, right? Higher highs. Now, when we break this low, and I'm looking to sell this market, which my direction would be derived from a higher time frame. If we get a break of this low, then I'm interested. Okay, get a nice break, we can start selling down here, stops above here, and I'll look to take price lower. But again, I'm going to let market structure and candles tell me this, not stochastic indicator, which is lagging, right? All indicators are lagging. So I don't want to use lagging information. I want to use real-time information, okay? And again, if that is your strategy, it becomes overbought, I start selling, get a robot.
Divergences. Divergences occur when an indicator displays an opposite signal of the real price movement. When this happens, it is usually a sign that the trend might reverse. Divergences can occur in many indicators such as the MACD, stochastic, and the RSI. For example, here, using the MACD indicator, you can see that the price is forming higher highs, which is bullish, but the indicator shows the opposite, a lower highs, which is bearish. In this case,
again, okay, the indicator can show you this. But again, right, if you're interested in selling the market, wait for a structure break, right? You can see we're in this upward trend. If I get a break of this level through here, where price has reacted before, and we get a break of this level, then I'd be interested in selling it. Again, I don't need a divergence indicator to tell me that.
this is a bearish divergence, which signals that the price may form a reversal, and so you can take a sell position. Volume indicators. These are types of indicator that shows the strength behind a price movement by tracking the trading volume. Notable volume indicators include price volume, which displays the volume for each candle.
Volume is one of those indicators that are real time, right? It's volume in the market at that time. But look, if you look at a huge volume candle here or a marker, right? This is huge volume in the market, this big green volume bar. But just look at the candle, right? The candle tells you there's volume in the market. Look at this candle compared to all these other candles, right? Blatantly obvious because of the candle that there's volume in the market. I don't need this to tell me that. Look at these two, right? Big volume markers. Look at the candles, right? Again, I don't need an indicator to tell me that.
The longer the bar, the higher the volume. Volume weighted average price, which shows the ratio of an asset's price to its total volume. It can be traded like a moving average or as a dynamic support and resistance. Volume profiles. It displays a volume.
Now, volume profiles, before he prattles on about them, these are really good for highlighting support and resistance levels. Okay. So, when you start seeing large pieces of volume like here, chances are that level price has reacted before. Okay. But again, I don't need the volume indicator or volume profile to tell me that. I can see the levels where price reacts on the chart, right? It's reacted here. Right, it's reacted here, right? It could in future react here. I don't need volume profiles to tell me that.
Supply and demand. Also referred to as order blocks, these are zones where significant price movements have occurred. If price moves significantly upwards from a level, it is considered a demand zone. And if price moves significantly downwards from a level, it is considered a supply zone. Just like support and resistance, these zones can be treated as key levels for potential entry positions.
Exactly that, right? I mentioned it before, supply and demand, support and resistance, fair value gaps. They even use the term order blocks. They all mean the same thing. They are areas on a chart where price has reacted previously and therefore are a good area for price to react in the future. And it's as simple as that. I don't care what terminology you use. You need to highlight where the market can react. And just picking a random chart like this, right? You can see this was proving to be good resistance. So if I draw a level through here, we know that price has reacted here. It's reacted here. Now, when it breaks that level, what was once good resistance becomes good support or a good demand level or a good order block. It doesn't matter. And then price moves up accordingly. These are the areas you want to spot, okay, regardless of the name of them.
Market structure. Market structure is when trader analyzes the behavior, condition, and flow of the market. An uptrend structure is characterized by price forming higher highs and higher lows, while downtrend structure is characterized by price forming lower highs and lower lows.
This is what you need to know. It's taken him 3 hours to get to this, but this is what you must understand, guys. I keep saying your number one job. Your number one job is to understand the trend that you are in. And to do that, you need to understand structure. And when I say structure, I mean you need to pinpoint the highs and the lows of the market. Okay. And then once you join these up, right? You therefore can tell what structure you are in and therefore the trend. We are in a downtrend because we're getting lower highs, lower lows. And then you trade with trend, right? This will be a sell trade that you would be looking for. Obviously, there's more to it. You need to find support and resistance levels to trade from, or dynamic support, which we spoke about earlier. These are good levels to trade from. But you must have a direction. You must have an idea of the trade you're looking for. Are you looking for buy trades or are you looking for sell trades? And market structure dictates that. It is uber important.
Break of structure. It is when price breaks the previous price peak during a trend. For example, if the price forms a higher highs and higher lows, this break of the previous highs is called break of structure. Change of character. It occurs when price breaks the previous structure during a trend, often signaling a reversal from that current trend. For example, if the price is forming higher highs and higher lows, then it breaks the previous lows, forming lower lows.
Yeah, so breaks of structure and change of character are the same thing. So this was the levels that he was talking about. He was like, right, when we break these highs, that's your break of structure. So all that's doing is confirming the trend you're in, right? As soon as we break this high here, right, we break this high, we're in an uptrend, okay? Now, when we break the last high, it is a confirmation that we are still in the uptrend, right? Retrace, breaks the high, we're still in an uptrend. Retrace, breaks the high, we're still in an uptrend. It's a continuation of trend. Now, if we break one of these higher lows, the last higher low specifically, then that is a change of structure. They call it a change of character, but it is a break of structure and a change of trend. Okay, because as soon as we break this low, we start to get a new market structure. We're now getting highs, lower highs, low, lower low, potentially lower low. Okay, and these are the things that you must know and understand. You need to understand the structure and trend you're in, and you need to know exactly when that structure breaks and therefore trend changes. So yeah, that is all every trading strategy explained in 12 minutes. I just wanted to show you how price action is so important in everything that you do with trading, okay? Because it can explain pretty much every indicator and every reason why you should take a trade, right? So guys, if you're new to trading, understand price action, then you can build on top of that foundation with perhaps indicators or some other addition to your strategy. But understand price action, guys. And also don't trade according to the moon. And guys, if you've enjoyed the vid, please don't forget to subscribe to the channel, smash the notification button and smash that like button. Please come join our free Discord channel and I'll see you next time.